Hi everybody, this is lecture for topic 6 ACT3110 accounting for manufacturing. So remember there are 10 topics in this course. Topic 1 to topic 5 topics related to financial accounting. Topic 6 to topic 10 are topics related to management accounting. So starting from this topic, you will learn about management accounting. So this topic 6 is about it's like an introduction to management accounting. Okay, remember this. The person who do the management accounting work is called management accountant. A management accountant works under a manager. It means that the accountant has to prepare reports for managers. If the manager asks the accountant to calculate costs, then the accountant has to calculate costs. If the manager asks the accountant to prepare budgets, then the accountant has to prepare budgets. So a person who do financial accounting work is called financial accountant. Okay, remember when you learn about management accounting, financial accounting, you learn about how to prepare income statement, balance sheet, etc. The person who do financial accounting work, a person who prepare the income statement, balance sheet, who record transaction in the ledgers, etc., they are called financial accountant. Now you are learning about management accounting, and the person who do the management accounting work is called management accountant. He works under a manager. He or the accountant has to do things that are asked by the manager. Okay, so when you know that a management accountant is working under a manager, you have to understand the function of management or the work of management or the work of manager. So in general, a manager has 3 functions or works. First, a manager has to do planning, and the second thing is a manager has to do directing and motivating, and the manager has to do controlling activities. So let's see in detail. Okay, what is planning? So planning is something related to the future of a business. So let's see. Planning activity is like this. A manager has to identify alternatives, select alternatives that does the best job of furthering organizations' objectives, and develop budgets to guide progress towards the selected alternatives. So planning is always related to the future of a business. If you are a manager, you plan for the future of your business. In management accounting, when we say planning, we always relate plannings to budgets. In management accounting, when you want to plan for the future of a business, you use budget. Budget can be a short-term budget, mid-term budget, or long-term budget. And the second activity of management or manager is called directing and motivating. So if you are a manager, most of the time your first activity is planning for your business. The second activity is directing and motivating. Directing and motivating means it involves managing day-to-day activities to keep the organization running smoothly. Employees' work assignments, routine problem solving, conflict resolution, and effective communication. So directing and motivating is like this. You are a manager. First, you plan for your business, and then you do something to implement the plan, the thing that you want to do. So directing means you as a manager has to ask people under you to do things. And motivating means something like this. When you have to work with people, you have to do motivating activities. You have to motivate people. If people are not like machine. If you work with machine, you just turn on the switch and the machine will do works for you. But if you work with people, you have to give them direction, and at the same time you have to motivate them to make sure they works every day, work hard every day. You have to motivate them. People needs motivation. And the number 3 activities of management is called controlling. The control functions ensures that plans are being followed, feedback in the form of performance report and compare actual results with the budget are an essential part of controlling function. So controlling means something like this. Controlling means in a simple way, it is like this. If you are a manager, you want to do controlling activity, the thing that you have to do is like this. You compare the actual data with the budgeted data, and then you make a conclusion, and then maybe you have to make correction. So let's say the situation is like this. You are a manager, and then your budget says for the month of June 2020, your budgeted sales is $100,000. So that is the budget. And then during the month of June 2020, you do the second activity, which is directing and motivating. Every day you have to you ask people to do works, you motivate them to do to work hard, etc. And then at the end of the month, you can do the controlling activity. Controlling activity is doing something like this. You compare the actual sales with the budgeted sales. Let's say at the end of the June 2020, your actual sales is $95,000. So how to do the controlling activity? You compare the actual sales, $95,000, with the budgeted sales. Your budgeted sales is $100,000, and then how much is the difference? The difference is $95,000 actual sales minus $100,000 budgeted sales. The difference is $5,000. The $5,000 is negative. The actual sales is lower than the budgeted sales. So that is showing an unfavorable situation. So that is the controlling activity. You compare the actual data with the budgeted data, and then you make conclusion. The conclusion is the situation is favorable, and then you have to make correction. You have to find a way to improve the situation of your business or your department. But if the budgeted revenue is budgeted sales is 100,000, but the actual sales is 107,000. So when you do the controlling activity, you compare 107,000 actual sales compared to the 100,000 of the budgeted sales. So you have 7,000 positive, 7,000 favorable situation. It is a favorable number. So you don't have to do correction. because the controlling activity shows that the controlling activity shows that the company is performing well, or the department is performing well. So that is the controlling activity. So this is the cycle of the planning and control activity. It begins with planning, and then you have to do things by implementing the plan, and then you do the measuring performance, which is comparing the actual data and the budgeted data. And then if you need to, you have to do some correction. That is the cycle of management, the cycle of the work of management. So if you are a manager, this is the thing that basically you will have to do. You have to do every month, every year, etc. Okay, now remember I have told you in this, starting from this topic 6, you will learn about management accounting. So here, okay, here you have to know the difference between financial accounting and management accounting. In this slide, the slide shows there are 7 differences. So let's see. Okay, you have to remember the most important thing first. Okay, I have to tell you something. Okay, the first, remember here the first difference is in terms of users. So always remember, when you learn about financial accounting, the main user of financial accounting is the external users. When you do the financial accounting, you learn about how to prepare income statement, balance sheets. Who will use the income statement and balance sheet? So the main user of the income statement and balance sheet is the external user. And for management accounting, now you are learning about management accounting. You have to aware that for management accounting, the main user of the management accounting information is the internal user. Maybe I have to tell you something before you see this one. Okay, remember about this. For financial accounting, the main output of financial accounting is the financial statement. Remember, when you learn about financial accounting, you would have to do journal, ledger, etc. And then at the end of the process, the output is income statement and balance sheet. Income statements and balance sheet are 2 components of financial statement. So at the end of the year, when you do financial accounting work, the output is financial statement. And the user of the financial statement, the main user of the financial statement is the external user. And then you remember this. For management accounting, every day, if you are a management accountant, every day you have to do many management accounting works. At the end of the process, the main output at the end of the process is budgets and cost report. Budget and cost report. So who are the people that will use budget and cost report? The people who will use the budget and cost report is the management or the internal user. Remember, I have told you, if you are a management accountant, your boss is the manager. He's a manager. You have to work under him. So the main user of your output, of the output of management accountant, is the manager. Okay, so the second thing is, okay, so remember the first difference between financial accounting and management accounting is the output. Financial accounting, the output is financial statement. Management accounting is, the output is the output is budget and cost report. And then in terms of user, financial accounting, the main user is external user. Management accounting, the main user is internal user or managers. Okay, see number 3 actually. Number 3, in terms of time focus. Okay, always remember when financial accounting, the focus is on history. Remember when you learn about financial accounting, you record things that had happened. So the focus is on the history, on the past. When the transaction happen, you record. So for financial accounting, the focus is on the past or history. But for management accounting, most of the time, the focus is on the future. Later, you will learn about how to prepare budget. So budget is something that is related to the future. So most of the time, for management accounting, our focus is on the future. And then number four, according to my list, in this slide, it is number 3, verifiability versus relevance. So you have to know this. For financial accounting, the emphasis is on the verifiability. Every record you made in financial accounting, it has to be something that can be verified. Okay, you have to have documents such as receipts, debit notes, invoice, etc. But in for management accounting work, the emphasis is uh, on the relevance for planning and control. In management accounting, when you do management accounting works, the emphasis is on the relevance. You add data in the management accounting work. You use relevant data. Your focus is on relevant data. When you do financial accounting, the focus is on the data that can be verified. Okay, number 4 in this slide, but number 5 according to my explanation. Precisions versus timeliness. Financial accounting emphasis on precision. Everything has to be accurate. If you put wrong number, then your balance sheet and income statement will go wrong. But in management accounting, the emphasis is on timeliness. You will learn in management accounting, you have to prepare all the or to do all the management accounting works quickly, because a management accountant work under a manager. Manager wants everything to be done very quickly. They have to make business decision very quickly. So if you are a management accountant, your emphasis is on the timeliness. Okay, I skip something. I think you have to see point 6 in this slide. GAAP. Okay, always remember, for financial accounting must follow GAAP. GAAP means accounting standard. When you do financial accounting work, you have to follow accounting standard. In Malaysia, our accounting standard is called MFRS, Malaysian Financial Reporting Standard. You have to follow that standard. Every company has to follow the accounting standard when they prepare the income statement and balance sheet and etc. That is for financial accounting. But for management accounting, you do not need to follow any standard, because when you do the management accounting work, you prepare the report for internal purpose only. You prepare the report for manager only, or people inside the business. So you don't have to follow any accounting standard. You prepare the report according to the needs of your organization. Okay, so that is the thing. Now, in this next slides, you will learn about cost. When you learn about management accounting, you have to know about cost. You have to calculate cost for your product or service. and also you have to prepare budget for your business. So everything is related to cost most of the time. So cost, remember this, in financial accounting you always hear the thing about expenses, and now you learn about cost. So do you think expenses equal to cost? Okay, so remember this. Basically, uh, in general, costs and expenses are different. Okay, remember this. Costs are amount that a business uh, pays to produce product or to provide services. Most of the time, cost can be defined as an amount that a business pays to produce product. Expenses, on the other hand, amount that a business has to pay to continue the operation of the business. Okay, let's see the things here. There are costs can be categorized into many types. Okay, just like people. When you see a group of people, you can categorize them into gender, citizenship, what else? Gender, citizenship, education, etc. Just like cost also can be categorized into many categories. Okay, here the first category of cost that you have to see is the manufacturing cost. Okay, manufacturing cost means the cost that a business has to pay to manufacture or produce something, to manufacture its product. So in accounting, if in accounting, the cost to manufacture a product are three, or there are three costs that a company or a business has to pay to manufacture a product. The first one is direct material, the second one is direct labor, and the number three is manufacturing overhead. So the example is like this. Let's say you have a business that produce frozen food. So in accounting, the cost to produce the frozen food, there are three costs that you have to pay to produce the frozen food. The first one is called direct material, the second one is direct labor, and the third one is manufacturing overhead. In this slide, the slide uses car production as an example. To produce a car, the company has to pay direct materials, direct labor, and manufacturing overhead. Let's see in detail. Okay, raw materials that become an integral part of the product and that can be conveniently traced directly to it. So this is the definition for direct material. Okay, so the simple definition is like this. A direct material is a material that is directly related to a product, or things that can be seen in the product. So for example here, the product is car. So what is the direct material? Direct materials are the tire, the engine, the chassis, the window, the windscreen, etc. Things that you can see in the product. So that are the direct material. What is the direct material cost? The direct material costs are the amount that you pay to get the direct material. So let's say you have a product. Let's say your product is a soft drink. So when you see the soft drink, you can see the direct material. You can see the bottles, the label, the water, the ingredients inside the water. They are all direct materials. How much is the direct material cost? The direct material cost is the amount that you pay to purchase the bottle, the label, the ingredients, and the water. Okay. And then the second category of manufacturing cost, the second manufacturing cost is the direct labor. Direct labor, there are many labors in a manufacturing business. if you see in a factory, there are many laborers, there are many workers. Some of them are direct labor. Okay, remember this. Direct labor are those labor that can be easily traced to individual units of product. Okay, another definition of a direct labor is like this. A direct labor is a labor that is involved directly in the assembly of the product. Yes, if you in this example, the product is car. The sample product is car. So direct labor for this example is people who involved in the assembly of the car. In this car factory, there are many laborers and workers. Only some of them involved in the assembly of the product. Other workers, they are not involved in the assembly of the product, even though they are working in the factory. For example, the janitor. Okay, the janitor only clean the building. They work in the factory building, but they do not involve in the assembly of the car. So janitors are not direct labor. They are another group of labor. And the second example is a supervisor, factory supervisor. In a factory, the factory supervisor responsibility is to monitor the workers. He has to know to take the attendance, to make sure the workers work on time, to make sure that the workers are paid according to the job spec, etc. But the supervisor is not involved in the assembly of the product. He just responsible for the workers only. So the factory supervisor is an example of a factory supervisor is not a direct labor. A direct labor is a people who involved in the assembly of the product. So the salary of the direct labor is called the direct labor cost. So example here, wages paid to automobile assembly workers are the direct labor cost. Okay, number 3, manufacturing cost. There are 3 types of manufacturing costs. The first one is direct material, the second one is the direct labor, and number 3, it is called the manufacturing overhead. So manufacturing overhead, the simple definition is factory costs other than the direct material and the direct labor. If you have a big factory, you have to pay many costs. Let's say in 1 month you pay 150,000 costs. So some of the costs, let's say 50,000 is direct material costs. Another 50,000 is direct labor costs. So how much is the manufacturing overhead? Manufacturing overhead costs are costs other than the direct material and direct labor. Okay, manufacturing overhead can be divided into 3 categories actually. The first one is indirect material, the second one is indirect labor, the third one is other costs. Okay, let's see what are the indirect materials. Indirect materials are materials used to support the production process. For example, the lubricants and cleaning supplies used in the automobile assembly plant. Lubricants and cleaning supplies are not direct material because you do not put this thing into the car, but you use these 2 materials to clean the building, to maintain the machine, etc. So they are called indirect materials. Indirect materials is under the manufacturing overhead. Okay, and then the second type of manufacturing overhead is the indirect labor. Indirect labor are wages paid to employees who are not directly involved in the production work. Remember, I have told you before, factory supervisor he is not a direct labor, but he is an indirect labor because he's not involved in the assembly of the product. And also you have janitor. He's not a direct labor, but he is an indirect labor. And then security guards also is not a direct labor. Maybe some engineers also not a direct labor. Okay, good. So that is the second type of manufacturing overhead, indirect labor. The third type of manufacturing overhead is other costs. Like the other cost is like depreciation of the building, factory building rental, factory building insurance, etc. Okay, they are all overhead costs. Okay, if somebody asks you, what are the costs that a business has to pay to manufacture a product, then the answer is direct material cost, direct labor cost, and manufacturing overhead cost. Okay, always remember that. If I give you a list of costs, that I give you 10 costs, 10 types of costs: direct material, direct labor, rental, etc. You have to know which one is direct material cost, which one is direct labor cost, which one is the overhead cost. Okay, this is the second category of cost. In a manufacturing business, okay, always remember, when you learn about management accounting, you always focus on manufacturing business, because management accounting is related to calculation of cost. So only manufacturing business has cost. A manufacturing business is a business that purchase raw material, process the material, and produce the finished product. So in a manufacturing business, some costs are manufacturing costs, some costs are non-manufacturing costs. If you have a factory, you have a factory section, and also you have a management office. Things that you pay related to the factory, most of the time are manufacturing costs. But the things that you pay in the management office are most of the time they are non-manufacturing costs. Okay, remember this. Manufacturing cost plus non-manufacturing cost equal to total cost. Okay, so now let's see what are the non-manufacturing costs. Non-manufacturing costs can be divided into two categories: selling costs and admin costs. Selling costs are costs necessary to secure the order and deliver the product. If you have a company, you have a worker that you ask to handle customer orders, then his or her salary can be categorized as selling cost. And also, if you have a company, and then you have a lorry driver, his responsibility is to deliver product to customer. So his salary is an example of selling cost, because his activity is related to deliver product to customers. So if you have a company, you have a salesperson, the salary of the salesperson is a selling cost. Okay, the second type of non-manufacturing cost is the admin cost. The admin costs are other management costs. The admin costs are costs other than selling costs. So most of the time, these two categories, they are called expenses before. When you learn about financial accounting, you record these two non-manufacturing costs as expenses. when you record about expense, you record the expenses of a business. You record the salaries, rentals, electricity or utilities, and then etc. Many things. So actually, the expenses are non-manufacturing costs. Okay, costs also can be categorized into product cost and period cost. Very easy, this one. Okay, just remember, product costs are costs that a business has to pay to produce a product. So product cost is same like manufacturing costs. Product cost and manufacturing costs are the same thing. When you produce something, you have to pay for with something, and when you manufacture and producing things are same. So product cost, if a question asks you what are the product costs equal to direct material cost plus direct labor cost plus manufacturing overhead cost. They are same. Why we call them product cost? Because the cost will increase every time you manufacture a product. If you manufacture one product, the cost is this much. If you manufacture 10 products, the cost will increase according to the number of the product. So that is why we call it them product cost. The second type, the cost also can be categorized as period cost. Period cost equal to non-manufacturing costs, equal to selling expenses and admin expenses. Why we call them period costs? Because most of the time, this cost has to be paid periodically. You have to pay them every month or every year or every 6 months. For example, the depreciation. I have told you. Let's say you have a management office, and then the salary of the lorry driver. Do you pay? You pay the salary of the lorry driver every month. So it is a periodic cost or period cost. You pay the rental of the management office building every month. So it is a periodic cost. You pay the salary of human resource manager every month. So it is a period cost. You pay every time or related to time. So if I give you a list of 10 costs, you have to know which one is product cost and which one is the period cost. Okay, let's see this one. Which of the following costs will be considered a period rather than a product cost in a manufacturing company? Remember, what is a period cost? A period cost is most of the time the cost that you pay periodically, and there are most of the time selling costs and admin costs. So what is the answer for this question? Which one from A, B, C, D, E are the period costs? So let's see the answer. The period costs are property taxes on corporate headquarters and the sales commission. So period cost always related to management office. It is not related to factory. And then classification of costs. Okay. Costs also can be categorized into prime cost and conversion cost. This one you have to memorize. Prime cost equal to direct material plus direct labor. Conversion cost equal to direct labor plus manufacturing overhead. Let's say I give you a list of costs. I give you a list of 10 costs or 15 costs, and then I ask you to calculate the prime cost. So you have to know prime cost equal to direct material cost plus direct labor cost. And yeah, if I ask you to calculate conversion cost, then you have to know conversion cost equal to direct labor cost plus overhead cost. Very easy. You just need to memorize the formula. Okay, this is like a revision. Remember about this. When you learn about management accounting, most of the time you have to you are learning about a manufacturing business, because management accounting is related to calculation cost of cost and preparing budgets. So on the manufacturing business, they have costs. If you have a service business, you do not produce anything, so you don't have manufacturing costs, but you provide services only. So most of the time the focus is on the manufacturing cost. So what is the difference between uh, manufacturing business and a merchandising business? So just remember, a manufacturing business is a business that purchase raw material, process the material, and produce finished product. But a merchandising business, the business is like the supermarket or grocery shop. The business purchase finished goods and sell the same thing to customer. So most of the time our focus in this ACT3110 is on the manufacturing business. So let's see. So when you prepare a balance sheet for a merchandising business, you have one type of inventory only. Remember, the the merchandising business, the business purchase finished product like rice, sugar, bread, flour, etc., and sell the same thing to customers. So all the inventories are finished goods. But if you have a manufacturing business, you will have three types of inventories. Because remember, manufacturing business is a business that purchase raw material, process, and produce finished product. So the manufacturing business has three types of inventories. First, the raw material inventory. The second is work in process inventory, and number three is finished goods inventory. So these are the definitions. Definition for each type of inventory. What is raw material, what is the work in process, and the completed or finished goods. Okay, so this is the first lecture. You can communicate with me in the comment section.